Mr. Bory, you call this a warning light, as we have a flatter yield curve coming down. A lot of people are saying, yeah. You're not going, yeah, are you?
No, I'm not. I mean, a flat curve tells you something. It tells you something about the markets, tells you something about expectations going forward. And I think most importantly, especially for people in the world of fixed income, it tells you about the amount of money you can earn by selling short and lending long. And it gets increasingly difficult to basically earn your carry, which is that terminology of selling short and buying long for a fixed income investor. As the curve flattens, carry as a mainstay of your portfolio strategy becomes harder and harder to come by. And our biggest concern is that what it ultimately does, it starts to pull investors back towards cash. And we know the Fed has spent the last several years, the last decade really, trying to get people out of cash and into other things. As that curve flattens, regardless of why it happens, it starts to pull you back the other way.
Bring up the chart right now. Justin, I'll get this out later. We'll put it out on TV Go here in a bit. I'm doing this on the fly. It's like a morning briefing for Global Wall Street. Get over it. Down here, 0, where the 2-year and the 10-year are the same yield, and anything down below here, George, is the end of the world as we know it. We're coming down here, and Mr. Gross told me that he's looking at this 45 level in here. Do you, as a strategist versus an investor like Mr. Gross, do you have a tip point where it becomes recession-like? I got to make some headlines here.
Well, I think you can easily say that between 50 and 100 and 0 is really, it is the flashing sign. Things are starting to get a lot more challenging. Above 50, you can always kind of explain it away. You could say like, well, things are okay. There's enough carry in the trade to keep doing it. But sub 50, as you approach 0, becomes a lot more challenging. And 50 to us is a key tipping point.